Hello and welcome to Morning Markets. I'm Roger Peterson. Here are some of the stories that we are tracking for you in the BNN Bloomberg newsroom. Shares of Barrick Mining are trading higher, up just under 2% right now. The company is shaking up management after reports Elliott Management had built a large stake in the miner. That emerged yesterday. Bloomberg has obtained a letter to employees signed by the CEO mentioning changes to the regional operating model of the Toronto-based company. 2 senior managers and a top executive are departing as part of the overhaul. We're watching shares of Brookfield today. It's up a little over 1% right now. The company is partnering with NVIDIA and the Kuwait Investment Authority to introduce a $100 billion U.S. global AI infrastructure program and fund. The new project is looking to make purchases in AI assets across energy, land, data, and other aspects of the infrastructure chain. The fund launches today with a target of $10 billion U.S. in equity commitments. Shares of Lowe's are seeing a spike, 5% right now. The home improvement company topped expectations on profit, helped by consumer spending on home renovations. Lowe's also posted growth in same-store sales on strength in its digital channel and home services. Sales to professional contractors also saw continued growth. And looking at the markets as we await the NVIDIA earnings report, the TSX recovering a little bit. It's up 0.44% right now. And south of the border, a bit of a mixed bag, shall we say. S&P 500 up by 0.47%. Dow Jones down by 0.15%, and the NASDAQ up 0.85%. The AI boom has been a major force driving markets to new highs, with NVIDIA emerging as one of the key catalysts behind the rally. Well, today, attention, of course, turns to NVIDIA's earnings after the markets close. Is there an AI bubble forming, and what are expectations heading into this crucial release? Let's unpack with Carol Schleif, Chief Market Strategist at BMO Private Wealth. Carol, thanks very much for joining us.
Thanks for having me.
I guess the big question is, of course, is the AI boom a bubble? Is it frothy, or is there a lot of room for it?
Well, we don't think it's a bubble yet. We think we're really early in the process, although there are clearly signs of froth that people are watching, and we are watching as well, in terms of not only the spending itself, but how it's being financed and who's financing who, and some of the circularity and that stuff. But there's more to run on the technology, more to run on the investment, and it's really important, as we keep admonishing investors, to remember who's doing the spending here. The spending, for the most part, is being done out of cash flow from very profitable companies that have historically had very low debt. They've funded their CapEx to date for decades, many of them solely out of cash flow. And so they're starting to expand the use of balance sheet, which from a numbers standpoint has people blinking hard, because there's some big numbers to finance some big data center builds. But so far, when they can get every one of those turned on, they're capacity constrained, the use is there. And we don't think there's a lot of differences to the 95 to 2000 tech bubble, which I lived through that one too.
What are some of the noticeable differences then to you that are standing out compared to that bubble?
Yeah, I think the primary thing is that these are legit companies that are generating the cash flow for investment out of other businesses that they're running. They're generating it out of cloud businesses. There's a very narrow list of people where you can go to if you want to move your processing from offsite to the cloud. There's a very narrow list of people you can use. They're taking that cash flow and investing it in other technologies to continue that cycle of innovation. Back in the 90s, a lot of what moved the markets, particularly by the time you got to the end, were ideas. The metrics changed. People justified the change in metrics based on the number of clicks or eyeballs you can generate, and they were mostly unproven business models. By the time we were through the 01, 02 downturn in particular, the NASDAQ had gone from 5,000 to less than 1,000, and the vast majority of the names that comprised the NASDAQ at the time went defunct. We're in a very different place now. We've got more sources of funding for these companies as well, not only banks, but a substantial amount of private capital that's willing to step up and fund, and individual investors, sovereign wealth funds, pension funds, private individuals. There's lots of different places that they can get financing, and there's a lot more legitimacy to the business models these days.
Okay, and of course, NVIDIA reports after the bell today. Is it so as NVIDIA goes, the AI goes, and the tech go?
That is the admonition, and it really takes me back, because honestly, when I started in the business, it was as goes the auto industry, so goes the market, because they were such a big component of GDP. But AI is definitely the bellwether for the industry. People will look to AI and look for a Goldilocks report, because they want just enough spending, but not too much to add more fuel to the frothy fire, if you will, or the admonitions there. So they'll be looking closely at that. But it's also important for investors to remember that while the stock price has moved up a lot over the last couple of years, earnings have too. And so when you dig into and parse the valuations of these companies, particularly debt to total assets and debt to return on equity and things, a lot of these companies, the valuations have really not moved as much as the prices would lead you to believe, because the earnings have been there.
And what do you want to hear from the CEO tonight?
Well, continued optimism, which he's produced. You know, there will come a point in time, because the street doesn't just expect NVIDIA and others of the key technologies just to beat. They expect to beat by a lot. And there comes a point in time when the law of large numbers means that you have to start leveling off in there. But I'm sure he will get some questions about the financing and the backing and and how the circularity works and a lot of that. But I would hope that they ask him as well about some of the new things they're working on, because there's a lot of other things I know that they're working on as it relates to quantum computing and photonics and lots of things that expand beyond artificial intelligence.
All right, and just going to the other side, I guess, the government, the Fed rate cuts, how much of a factor is that now? Or is everybody just kind of bracing that not much is going to move right now?
No, I think it layers into some of the concerns too, because we've had big market moves. It's been a volatile couple of weeks to start November, but we ended October with 6 months worth of gains off of most major global indexes. And so people are looking at the Fed as another factor, and the fact that Chair Powell opened it up last week, or at the last meeting, and was very pointed about noting the contention, if you will. He didn't use the word contention, but that there's not unanimity among the crowd. And we've seen from the speakers that have come since then more of that. So I'm sure the Fed minutes from that meeting that are out this afternoon will also get some parsing.
I bet they will. Do you see any cuts in the future, in the near future?
Yeah, we do. We still expect them to cut in December. If they didn't cut in December, they might roll it to January, but we'll get inflation numbers. We get some of the backed up inflation numbers will come next week. We're starting to get employment numbers, and so we'll see those. And we do suspect that the crew, if you will dominate on the side of the labor market is showing softness, and that's where the focus will be.
Okay, Carol, thank you very much for joining us today.
Thank you.
Carol Schleif is Chief Market Strategist at BMO Private Wealth. Up next, there's a leadership shakeup in Barrick amidst media outlets reporting a potential breakup. We'll talk about that after the break. Well, Barrick Mining is apparently overhauling its regional operating model and bringing in some new management. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay. Lindsay, thanks for joining us on this. Been a bit of a week.
It has been
Barrick,
a bit of
hasn't
a
it?
week for Barrick Mining.
And it's only Wednesday.
And it's only Wednesday, so we're going to have to wait and see what happens Thursday and Friday. But yeah, this is the latest from Barrick Mining. So this is an internal memo that was sent out to employees. It's been obtained by Bloomberg. And in it, the CEO, Mark Hill, outlined a number of changes. And some of those changes, as you mentioned there at the top, is change in management. And this is all in a bid, apparently, to improve performances. So we've got 2 senior managers and a top executive departing from the team, and they have already been replaced. That was announced in the memo as well. Also announced in this memo is one of the company's giant mines in Dominican Republic will be moved to Barrick's North American unit. It was previously part of Barrick's Latin America and Asia Pacific unit, and this is all in a move to strengthen Barrick's North American unit. Obviously, that unit also has the 4 Mile project, which we were talking about yesterday. That's the big mine in Nevada that was discovered by Barrick Mining earlier this year, potentially one of the biggest gold discoveries and most important gold discoveries of the century, and it's 100% owned by Barrick. So all of that underneath that North American unit by Barrick Mining, that's a pretty big deal. So obviously, as I mentioned, that's all in a move to strengthen that side of it. And of course, this also follows, operational difficulties, cost overruns throughout the year. It's been a bit of a difficult year in some ways for Barrick Mining, and rumors that the company might be splitting in 2. So the North American side of things and then the Asia and African side of things. And this is apparently all being pushed by Elliott Management, which we've been talking about a lot this week as well.
Yes, and what is the latest on Elliott? They took $700 million, I believe, is what they took shares.
This is the reports. We're still waiting to get this confirmed.
Yes, the reports.
But there's many reports. There's fresh, renewed reports today from different outlets saying that this is at least $700 million US stake being built into Barrick Mining by Elliott Management. So waiting, again, I reached out to Barrick Mining yesterday. They said no comment. I've reached out to Elliott Management. They have not responded. But this is reportedly all of these changes are coming from pressure from Elliott Management to make these changes. Under the plan being pushed, one of the post-split companies would own Barrick's lower risk mines in the Americas. The other would hold higher risk properties in Africa, the Middle East, and Asia. So if this is true, we've seen Elliott do this before. I was mentioning a couple of examples yesterday. Those were mostly American companies. There are some Canadian examples as well. In 2022, Elliott led a successful shakeup of Suncor Energy in Calgary. Also in 2022, Elliott worked with Toronto-based Kinross on a share buyback. And since then, Kinross has been one of the top performing large cap gold stocks on the market. So Elliott Management has a history of trying to shake things up. It seems to go well most of the time. And we're still waiting to see what this actually means when it comes to Barrick Mining. Obviously, as I mentioned, neither company has responded with a firm confirmation for BNN Bloomberg yet.
Which makes you think there's some conversations going on somewhere.
As you say, it's only Wednesday.
It's only Wednesday. A couple more days. Okay, yeah. Lindsay, thank you for that.
You.
BNN Bloomberg's Lindsay Biscaya. Now, for his insight on the situation at Barrick, we're joined by Martin Pradier, materials analyst at Veritas Investment Research. Martin, thank you very much for joining us.
Thank you.
Your thoughts, does this look like it's unfolding as we've been talking about? It's all reports right now, but how realistic is it?
Well, Elliott Management, as the previous person said, has a history of doing this kind of stuff. I was in a meeting with management a week ago, and when they were asked about splitting, they said, no, we don't want to split the company. But the reality is that sometimes, the events force them to do that. And the new reorganization, it might be the split, right? Now you put Pueblo Viejo with North America. That's the most stable part. And then the rest is a little bit more risky, if you want. So it looks like it's moving in that direction. The real problem is they have to fix Nevada operations. I mean, Nevada supposedly is, very valuable, but if you look what happened the last 4 years, production, sales, it was down about 22% in that 4-year period, and the costs were up 43%. So that's a lot worse than competitors. So for Nevada to realize this value, it has to stabilize at least and start, moving in the right direction in terms of, increasing production and lowering the cost.
Well, the executives that have come in and the changes that have made, does that indicate that they might be able to, those are the men capable or people are capable of making those changes?
I don't know the executives. I cannot say if hopefully they are. I mean, that's a whole plan. I think the CEO was very clear that his focus is going to be North America, that he wants to straighten that operation. And I think this is related, right?
And how might a split unfold? I mean, we've heard North America, including Dominican, and then the rest, South America and Asia. What interest who would be interested in what there?
Well, I mean, it makes for a cleaner North American company that will have a lot of growth. And then you have another company that is a lot more risky. Because the reality is that the risk in some of these places where they're going is much higher than North America. Many of the operations are in Africa, and now they're going to Pakistan. I mean, it's a different risk profile than having a mine in North America.
There is. I mean, I'm looking at some of the things. They had that key mine in Mali being seized by a military junta, 3 fatalities there. Who would want to take on the risk involved in those mines? Are there people out there?
Yes, I mean, a lot of investors will still be interested. I think what it makes it clear is you have two different companies, so you can value the North American company higher, I think, and that's really the whole idea, and not being dragged down by all the other stuff that's going on with Mali and Pueblo Viejo also has been a challenge. I mean, the ramp up of that mine has been difficult, and they haven't reached their objectives.
And now Elliott possibly being in there, and they push for things like this. What's that doing to the company, do you think? If this proves to be true, that case, of course.
Well, I mean, that might be the catalyst for them to split the company. And if that's what Elliott is pushing for, I think it might be valued better being two companies than being just one.
Could we end up seeing this being a loss for Canada? Could we end up seeing the company move?
Well, they're probably going to keep the North American, and maybe the other parties goes away from Canada. I don't know. I don't know what is the end game here. You could still have the head office in Canada. I mean that the fact that you're split doesn't mean that you have to move the head office.
Mm-hmm. And we all seem to be making the assumption that it looks like it is going to be a split. Are there benefits for them to stay together?
Well, the only thing is the current plans. A lot of the capital expenditures were in the emerging area, right? In Pakistan and in Reko Diq, that is in Pakistan, and in Lumwana. So the question is, like, if that part of if you split them, if they will have enough money to complete all these investments.
Okay, Martin, thank you very much for joining us today.
Thank you.
Martin Prade is a materials analyst at Veritas Investment Research. Coming up, NVIDIA will report its earnings for the latest quarter. After the bell, we'll get some perspective on what to expect when we come back. All eyes are on NVIDIA today as the AI giant reports after the close. Analysts are estimating more than 50% growth for both net income and sales for the quarter. The big question is how the market will interpret the numbers. We got perspective from Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James.
we have seen mixed, quarterly earnings have kind of triggered massive swings in the past in NVIDIA's market value. So even if we're going back to, 2024, and, it goes in both directions, which I think is interesting. And just the impact that NVIDIA has had on the markets. Obviously, we have been investor in the stock, but it is going to be, and I think all eyes are going to be on NVIDIA, and really not just the earnings, but the guidance, I believe, will be key. So it's that can really shift sentiment across the entire AI space, especially around demand, margins, and the Blackwell rollout. So given how much that the stock has driven the market returns, really whatever NVIDIA says will move more than just the semis. So it is going to be a major event that we are watching after the market close. NVIDIA alone has driven close to 20% of the S&P 500's return this year alone. So this report will easily set the tone for the broader market. And I do think that volatility is expected, depending on either way, but options imply about a 7% move in either direction, so up or down, which could mean more than $300 billion swing in market value in the S&P 500 in really a single day. And that volatility, yes, is expected, but I think there are so many other AI names that are intertwined with NVIDIA as well, right? Oracle, OpenAI, and connected to the stock, that if almost one stumbles, we could see others that could follow suit. So these results matter far more beyond the company. I think they influence hyperscalers, data centers, enterprise AI budgets, which is why investors see this news as a signal for almost the entire AI sector.
And what might be a failure? I mean, there are some heady expectations from the analysts. We're talking revenue, $55 billion. I think it was a 56% increase year over year. EPS, a 56% increase. I mean, are those realistic? And what would the market accept, you think?
Yeah, and NVIDIA will probably meet the strong 56% year over year revenue growth that the market is expecting. But we also want to see how much of future revenue depends on the company where NVIDIA itself has invested. So NVIDIA is part of, yes, our broad-based U.S. holdings, but we still want to manage exposure, and clients need to manage exposure to those chip makers, data centers, hyperscalers, to kind of maintain control or risk over their entire portfolio. So I still think, yes, is that growth year over year sustainable? I think time will tell. I don't think over the long run, but again, being innovator and being a leader in the company, I think has allowed them to achieve that continuous double-digit growth. So again, I think guidance will matter most, as usual. The markets will want clarity on, the demand, on the margins, on the supply, and really whether this AI spending is still expanding or are there signs of cracks or starting to show some cooling off there?
Now, we just came out today. I don't know if you saw Brookfield launching a $100 billion AI infrastructure program. NVIDIA is going to be a part of it. Is that a factor at all in what's going to unfold over the next 24 hours?
Yeah, and this is why I think it's so important is again, they're so intertwined. NVIDIA is so intertwined with so many companies. It's not like we're just talking about NVIDIA anymore. So I think they have concentrated risk in the ecosystem a little bit, right? NVIDIA powers OpenAI. OpenAI drives Oracle's cloud build out, and Oracle's circles back for more NVIDIA chips. Now you're bringing in other companies to kind of come into that ecosystem that is a little bit of concentrated. That tight loop could be a little bit fragile, which is why I do think it's important for investors to manage, taking profits off the table and kind of avoid that excess exposure or highly concentrated exposure to some of the data center names. Or again, if you have a large position in NVIDIA, it's never a bad time to be taking profits off the table.
And that was Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. When we come back, we'll have a look at Microsoft and Amazon. They often sound like good investment options, but we'll be back to talk about why they have been downgraded by one analyst. Stick with us. Metro reported profit and revenue in its latest quarter that topped expectations. Sales grew more than 3% to $5.1 billion. The company's frozen distribution center in Toronto also resumed operations last week. Now, on the downside, same-store sales came in below what analysts were expecting. TJX beat estimates for sales and profit in its most recent quarter. The discounter that runs chains like TJ Maxx and Marshalls also raised its outlook for same-store sales and boosted its profit outlook for 2026. TJX Canada, which also owns Winners, posted an 8% growth in sales. The company says the fourth quarter is off to a strong start. Shares of Target are edging lower. The discount retailer trimmed its profit forecast for the full year as it deals with markdowns and soft demand in key merchandise areas. While third quarter results surpassed average analyst estimates, same-store sales fell by more than 2%. For the fourth quarter, Target is maintaining its expectation of a low single-digit decline in sales. Turning to the markets, TSX bouncing back a little bit today and up 0.3% south of the border. A bit of a mixed bag right now as we all await the NVIDIA earnings. The S&P 500 up by 0.27, Dow Jones down by 0.26, and the NASDAQ Composite up by 0.58. Tech and e-commerce giants Microsoft and Amazon, which are two of the Magnificent Seven companies, have been downgraded by my next guest to neutral from buy. He says it's time to take a more cautious stance on hyperscalers. Let's bring in Alex Heisel, analyst at Rothschild & Co. Redburn. Alex, thanks very much for joining us.
Thanks very much for having me.
Going against the grain, what are your reasons for this?
The work really shows that we have done is that the market is already pricing in, a very optimistic scenario in terms of like how much value generative AI really creates for both of them, for Microsoft and for Amazon, because everyone is still using, the traditional cloud playbook where the hyperscalers have been the kings of the cloud 1.0. And so if you look at it from a capital deployment and value creation perspective, in the cloud, they've converted one CapEx dollar in $1.4 of NBV. With generative AI, we're talking about one CapEx dollar of 20 cents of NBV. So I think there's a big mismatch. And unfortunately, we don't see a clear path for both of these companies to revert back towards these cloud 1.0 economics, because now you also have like new platforms in the game in the form of like Anthropic and OpenAI, because they are not just the apps that consumers see. They act as a platform layer, and that's where the value is. So it's much more competitive, and we see the risk that the hyperscalers operate much more in the lower part of the stack.
Now you have Microsoft. You mentioned Anthropic. Microsoft's investing $35 billion. Is that not going to ease that or ease your fears a little?
I mean, what will happen is Anthropic will use Microsoft infrastructure as it does with AWS and GCP. But for the hyperscalers, it mainly means like server rental and maybe some auxiliary services. But the value really accrues to the likes of Anthropic and OpenAI. So we have to really differentiate what is like a server rental versus like what is like the product on top of this service, and who actually captures the value in this.
What are some numbers you would like to see that would make you feel more comfortable with them?
What I would like to see is sustained reacceleration of growth, but CapEx coming down. Because unless we see this scenario, then the only conclusion that you have is the costs to grow are really high. If we would see CapEx coming down and the revenues accelerating, it means that basically the revenues per unit of compute is going up. That's what we need to see really to reassess our view.
And one of the things, of course, everybody's talking about AI, but also the other thing that we've been talking about is quantum computing. Where are your thoughts on that? Where do you see these companies going with that?
I'm probably not the right person to give you a really good insights in quantum computing, because my focus is really just on the hyperscalers.
On the hyperscalers, and
yeah.
And how much of an impact do you think NVIDIA's earnings today, when they come out after the bell, will have on these two, on Microsoft and Amazon?
I think the impact will be quite limited, because we have been in this period where the market has rewarded growth and capex, but with the recent earnings season from from the hyperscalers, Amazon and Microsoft. The growth was decent, but the market is starting to look beyond, the surface level top line and also like the RPO figures. So I don't think there's much of an impact because investors we speak to all try to get a head around what the value is. So I think it's getting much more nuanced, and I don't think there's any real impact from tonight.
Okay, and what gives you this confidence on these two with this?
Because that's what I spent most of my time. I really focus on the hyperscalers, Amazon, Microsoft, and also Oracle. And I think what gives us confidence is because since we've launched in June 2022, we have been defending these companies throughout that period. We had an above consensus view in terms of like re-acceleration, and it was a challenging time. So we had to turn every stone, and we wouldn't have made these changes without being very sorry in the work we have done.
And do you feel moving forward they have the abilities to adapt and change?
I'm sure they do. I mean, just to be very clear, the returns on this, generative AI deployments, being it like GPUs or for AWS Trainium 2, they're still okay. So we're looking for an IRR of like 15, 16%, but it's not the same as the cloud 1.0. And what we said is the problem is the market still prices these companies as if it was still a cloud 1.0, meaning that, there is a belief they can revert back to where they have been. And I think there's just no clear path towards this.
Okay, Alex, thank you very much for joining us today.
Thank you very much for having me.
Alex Heisel is an analyst at Rothschild & Co. Redburn. Coming up, in a highly anticipated report, NVIDIA is set to post its quarterly earnings this afternoon after the market closes. We'll get more on how that will affect the tech sector when we come back. Investors appear to be in waiting mode this morning. AI chip giant NVIDIA reports after the bell, and it's expected NVIDIA's third quarter results could shed some light on the validity of high valuations in the tech sector. We sat down earlier with Paul Harris, portfolio manager at Harris Douglas Asset Management. We kick things off with thoughts on the recent sell-off in the markets.
There was kind of a very bullish tone to the market, and it's nice to have these pullbacks. But, the Dow's down 3, the Nasdaq's down 4. So I think that's just not enough. I think what you really need to see over the next little while, if you see a 10% pullback, the VIX getting up well above 30, I think that would be much more seen as a capitulation and the stocks moving from sort of weak hands to stronger hands. But until I think you see that, and I think part of the reason why the market is so choppy, as you mentioned earlier on, is the fact that, there's a lot of things that we don't know about. The employment picture is very difficult because we haven't had any employment numbers. And that was one of the reasons the Fed was so worried about it earlier on in the year, and they cut rates. We don't know about inflation numbers. We don't know about, I think the market is saying that the Fed is not going to drop rates in December. So, but, what will they do in December? What are they going to be talking about is really important, I think. And so I think these things are all kind of leading to some uncertainty. And I think with that uncertainty, you're getting very choppy markets. But I think that you've seen a really kind of it's healthy in a bullish market to have pullbacks. I think that, sort of this is, I don't feel it's strong enough, but I think that, if you feel like putting some money to work here, it's fine. But I would say that you could see with these kind of uncertainties, a little bit a better pullback, and then I think that's a good opportunity to buy.
That's interesting. You'd be trying to keep your powder dry. Maybe we could put up a one-year chart for Meta, because that's come down quite a lot, partly on concerns about massive spending on AI.
Right. So I think the issue for Meta is because they're spending a lot. So Meta is unlike Meta is obviously an advertising company for all intents and purposes. They've got some great social media brands which people go to all the time, and so that's one of the things. I think the issue for Meta is that, with all this spending, if you look at Microsoft or Google or even Amazon, they have this cloud business which they can actually defer. People rent from them, so they can generate a lot of revenue by people renting their cloud space, even though they're expanding. Whereas Meta can't do that because they don't have a cloud business. And so what they're spending to actually be able to get somewhere down the road, better advertising returns, because they can use AI to effectively target people in a better way. They are doing that right now, but I think that the spend relative to what the revenue is on that, I think people are worried about. And I think that's the worry with Meta. It's come off because of that. Some positive things is that they were in court for their deals with Instagram and WhatsApp, and I think those things are all gone away. So that's a positive thing. That was overhanging the company a little bit, but I think that's a positive thing for them. I think they are seeing revenue growth from what they're spending, what they're doing, but I think the issue is that they're spending a lot, and like he did with the metaverse, people get worried that he spent a lot on that stuff, and then he sort of, I don't want to do this anymore, got religion, dropped all the cost structure. So I think they're worried that this may happen again. But I think if they want to be a player in AI, they need to spend the money to do that, right? And I think that it's a little bit more difficult for Meta than it is for the other players who are doing it, or the other AI players we normally talk about.
The new CEO at Barrick, I'm not sure, I can't remember if Mark Hill is interim or not, but anyway, shaking things up. I didn't realize that Barrick was seen as having such a weak safety performance, but Hill says it's deeply concerning, the safety record. And it looks like Barrick is in a hurry to win back investor favor.
Well, I think two things you have to remember about something like a company like Barrick in that kind of strong gold environment. These kind of large cap stocks obviously don't do as well as mid-cap names in gold because they don't, people think of them very differently. You want to get the most leverage to the gold price, and a mid-cap stock will do that for you. So Barrick, and even in a very hot oil market, you would notice that Suncor and C&Q would lack a smaller company, right? So I think that's what happens with a lot of these large cap stocks in a very bullish market for their commodity. That's one thing, and I think that's why people are irritated that Barrick has not gone up a lot. But I do, I think the issue for a lot of these companies is that they're not always in great areas of the world, and so they tend to sometimes can look the other way on certain things. I think that happens a lot, and although it shouldn't, don't get me wrong, it shouldn't happen, but there's a tendency. So I think that's what they have to deal with, right? They have to make sure that they don't have a situation like BHP ended up in, where you had this massive problem with a mudslide and all these other things. So I think what they need to worry about is making sure that they do have proper safety and they are taking care of all these things, especially when you're in a business like mining, right, where it could have massive impact on a lot of people's lives, not only in the mine but also around them, right?
Yeah, it's interesting. Bloomberg argues that the stock, as we just saw, it's up about 120% in the past year, but Bloomberg argues that it has lagged the gold group, and with gold hitting record highs, people are looking for top performance, obviously.
Yeah, and like I said, I mean, I think in a up commodity market, people tend to buy mid cap or smaller cap stocks that have better leverage to the underlying commodity. And Barrick is a big, huge company with many things going on, so I think it's much harder for those companies in that kind of environment to do as well as the mid cap range.
And he was speaking with Paul Harris, portfolio manager at Harris Douglas Asset Management. Coming up, we'll check in on where North American stock markets are currently trading. Well, for some of us, retirement is starting earlier and lasting longer, prompting some Canadians to worry about paying expenses once they retire. CTV's Heather Wright has more.
The number of people living past 100 has more than doubled in the last 25 years. And for some, retirement is starting earlier and lasting longer, forcing tough financial decisions.
I think in the economy today, people have to keep working.
According to a survey from Manulife, 42% of respondents say they are worried about paying for basic expenses in retirement. That's up from 28% in 2020. 43% are worried about health care costs in retirement, an increase from 31% 5 years ago. And nearly half say their retirement savings are behind schedule.
That concern around day-to-day expenses, this is something that is a concern for pre-retirees and everybody. So it's not surprising to me that that would also be a concern going into retirement.
While the number of people retiring early is increasing, it's not always by choice. According to Manulife, only 15% of those who retired early did so because they had saved enough money. 33% retired due to their health, while 13% retired to care for a loved one, which is why experts say planning for various scenarios is key.
Disability is a reality as you get older, and especially amongst seniors. It's just really critical that we're planning for that.
Fiona Cassidy is among the 15% who retired early by choice. She says having a plan is key, and so is starting early.
Getting the benefits of accrued interest is, that's a smart way to do it.
Experts say another factor to consider when retirement planning is inflation. And while it dipped slightly to 2.2% last month, the cost of living is still putting a squeeze on those on a fixed income. Heather Wright, CTV News, Toronto.
As Swedish royalty landed in Canada, the dogfight over which fighter jets to add to our country's military fleet kicked into high gear. Executives from Swedish manufacturer Saab are along for the state visit, making a sales pitch for the Gripen, adding to the rumors swirling about the Canadian Armed Forces considering a purchase of the Swedish aircraft. CTV's Jean-Pierre Beauchemin traveled to Stockholm to get a closer look.
This one, it's a Gripen E.
On a tarmac in Sweden, Saab showed off the fighter jet it hopes Canada will buy.
So it's really state-of-the-art systems packed in here.
Part of the company's sales pitch is that the Gripen is perfectly suited to protect the Arctic.
What we designed the system for is actually to be able to withstand the extreme max in terms of cold, so minus 40, minus 45. We should be able to land on a road on a full packed with ice, be able to turn around in 10 minutes.
As the battle of the fighter jets revved up, Saab also suggested Gripens could be assembled on Canadian soil, creating, it says, 10,000 manufacturing and research jobs. But some Canadian contractors say a deal with Saab could also cost jobs. L3 Harrison, Quebec is aiming to set up a maintenance hub for the F-35.
Here we're talking about preserving the jobs of 1,600 Canadians today, the creation of an additional 5,000 jobs for the F-35.
In 2023, Canada agreed to buy 16 stealth fighters built by U.S.-based Lockheed Martin, with an option to scale up to 88. But Ottawa is reviewing the deal in the middle of a trade war. Industry Minister Mélanie Joly said today Gripen's job offer is interesting.
I don't believe that we've had enough jobs created and industrial benefits done out of the F-35.
But Lockheed Martin says about 30 Canadian companies are currently involved in the F-35 supply chain, and that it expects to produce over $15.5 billion in industrial value for Canada, with projects since 2007 and spanning through 2058. Analysts say Canada faces a tough choice.
There's a lot of value to the F-35 contract, as the armed forces have said in the past. It is a fully integrated aircraft. It's the most advanced fighter that we have in the Western world. The question you have to ask yourself, is that aircraft overkill for Canada?
This is how you refuel an aircraft.
Saab hopes an assembled in Canada Gripen will fly.
I mean, there's no secret. Canada has a very skilled workforce.
For Canada, it's a high-stakes decision, and the results will be measured in years to come. Geneviève Beauchemin, CTV News, Stockholm.
Prime Minister Mark Carney has embarked on a week-long trip to the United Arab Emirates and South Africa for his latest trade-seeking mission. CTV's Rachel Aiello has more.
Prime Minister Mark Carney is embarking on a nearly week-long trip to the United Arab Emirates and South Africa. And he's hoping to return with stronger diplomatic ties, as well as new trade and investment agreements. Visiting two of the world's largest emerging markets, Carney is hoping to attract capital to Canada to help build major infrastructure projects and fuel this country's energy, defense, and technology sectors. The Prime Minister's first stop will be in Abu Dhabi. There, he will meet with the President of the UAE. It will be the first visit from a Canadian Prime Minister since 1983, when Pierre Trudeau went and brought a then-young Justin Trudeau with him. The Prime Minister will also meet with heads of major investment funds and deliver a keynote speech to a business crowd. Carney will then travel to Johannesburg on Friday. While there, Carney will meet with South African President Cyril Ramaphosa, and senior officials say they're hopeful the two countries can come away with an agreement to boost bilateral trade. But the main event will be the G20 Leader Summit taking place this weekend for the first time on the African continent. On the sidelines of the summit, Carney is set to hold a series of bilateral meetings. And while his office won't yet say which world leaders he may be sitting down with, we know U.S. President Donald Trump won't be one of them, as the Americans are boycotting the G20. Rachel Aiello, CTV News, Ottawa.
Market Call is coming up next, and today on the show we have a new guest to Market Call, Tim Regan. He is Managing Director at King West & Company. We'll be taking your questions on North American large caps. All right, let's see how the markets are shaping up, of course, as we await the NVIDIA earnings report. Looking at Bay Street right now, you can see the TSX up today, 0.27%, just looking at the different groups. Pretty much it's a split right now. You got info, materials, healthcare, industrials, real estate, and energy all on the plus side. Info, the tech, they're up 2.71%. On the downside, we see the construction and financials, utilities, and staples, and consumer staples and commercial services, or commerce and communications, they are off by about 1.2% right now. And south of the border, things are a mixed bag down south of the border. You can see the S&P 500, it is up 0.27%. Dow Jones down by 0.18. NASDAQ is up by 0.53. And of course, right now, NVIDIA, I was just taking a look. NVIDIA is up right now. And as we await their earnings report, and of course, we'll be looking for a few things. Just mostly it'll be about their guidance, where they are heading, and what they plan to do. And of course, another one that people will be keeping an eye open for is their Chinese revenue. If the company disappoints on that, it could be some concerns raised. So we'll have to see. And of course, their earnings coming out after the bell. Thanks for watching Morning Markets. We'll see you back here tomorrow.